The United States economy is slowing down. This morning, we got the latest GDP numbers, which came in at 1.1%. The GDP is our gross domestic product, and essentially what that tells us is how fast is our economy growing. Now, our GDP was expected to grow last quarter by 1.9%, but this morning the number came in at 1.1%, which means essentially that our economy is slowing faster than what economists predicted. Now, the reason why this is so important is because, one, there's been all this talks of a potential recession and what's going to happen if the economy slows down. And then second is because inflation is still high. And today, according to Fortune magazine, we got the Federal Reserve Bank's index for PCE raised from 4.2%, which was higher than the expected 3.7%, which means the expectations for inflation are also now rising. So you have inflation expectations rising, the economy slowing. And the reason why this is so important is because of stagflation. Now, stagflation is something that I've been talking about for a little while now. And what's interesting is when I first started talking about it in 2021, 2022, around that time, the Federal Reserve Bank kept saying that stagflation is not even in the realm of possibilities. Now, here we are today, and we have more economists and investors talking about the risks of stagflation. So let me start by explaining what stagflation is, because stagflation is when you have two things happen. Number one is you have high inflation, and number two is you have a slowing economy. And that means essentially that you have the prices of things rising while wages are falling. So it's a double whammy. And the last time we saw this type of stagflation was in the 1970s and early 1980s. And today, Chris Campbell said this. He said he's, quote, growing increasingly alarmed about the possibilities that the U.S. might be facing stagflation. Now, why or how could we be facing stagflation? Well, we're seeing the economy slow down, and soon we're going to be getting more inflation data. And if this inflation data is starting to trickle upwards, now we have the worst of both worlds. We have rising inflation, if that continues to happen, with a slowing economy. And that would mean essentially people are losing jobs, wages are going down, people's ability to pay people are going down while the price of things are rising. That is a difficult thing to solve, because now if the Federal Reserve Bank tries to solve the slowing economy by cutting interest rates and stimulating, you can boost the economy, but that's going to make the inflation problem already worse, because, well, if inflation is high and you print more, that makes the inflation problem worse. So this is where now the question is, what's going to happen next? Because in the first week of May, the Federal Reserve Bank is going to meet, and they're going to have to make a decision of what they want to do with interest rates. And the reason why this is important now is because previously, the Federal Reserve Bank would only look at two things when they made their interest rate decisions. Number one is they would look at inflation, primarily core inflation, and then they would look at the jobs numbers. And they would say, okay, inflation is very high and unemployment is low. And because inflation is high, unemployment is low, we have the fuel and the reasoning to go out and raise interest rates. Now it's a little bit different, because on one hand, we have high inflation still, we have low unemployment, but then we have this third factor that the Federal Reserve Bank is starting to look at, and this is the economy. And we saw this especially last month when the Silicon Valley Bank collapse happened, because a little bit before the Federal Reserve Bank's last meeting, we saw Silicon Valley Bank and Signature Bank collapse. And the Federal Reserve Bank then raised interest rates by 0.25%. And then we later found out that the Fed was thinking about not raising interest rates at all. But before the bank failures, they almost raised interest rates by 0.5%. They were going to raise interest rates by 0.5% because of how high inflation was, but because of the bank failures, because of the economic issues going on, they decided to only raise interest rates by 0.25%, and they were also debating not raising interest rates at all. So this brings us to where we are today, and this is what we did a full deep dive on in Market Briefs, my free financial newsletter. But this is where now today, the Federal Reserve Bank is starting to look at all these numbers. They're seeing the GDP numbers, and they're saying, okay, our economy is growing, but not growing as fast. It's actually slowing faster than expected. Then they're going to be looking at the inflation numbers. Okay, inflation is still very elevated. And then they're going to look at the unemployment numbers. Okay, unemployment is still low, but unemployment is the lagging indicator, and then they're going to make a decision on what they want to do with interest rates. Now, if you want to stay up to date on what the Fed is doing, on what's going on with the economy, the stock market, the housing market, and everything in between, then I highly recommend you join Market Briefs, my free financial newsletter, because it's an easy way and a free way for you to stay up to date on what's happening, and the newsletter is very fun to read. So if you want to join Market Briefs, it's completely free, and I'll put the link to how you can join down in the description below. So now, when the Federal Reserve Bank meets in the first week of May, they're going to have to make a decision of how aggressive they want to be to bring inflation down. And what they have said up until very recently is essentially the number one priority is bringing inflation down. Now, as we're starting to see the economy slow down, the question is, when is the Federal Reserve Bank going to flip, or are they going to flip? And Morgan Stanley today also gave out their own statement to their investors. I'm going to read you a quote from a letter to their own clients about their opinions about the economy now. Here's what Morgan Stanley had to say. This is from Morgan Stanley's chief United States economist. They said that after the slowdown in the economy, they, quote, expect to see significant slowing into 2023 as the cumulative effect of tighter monetary policy as well as the banking pressures push growth into negative territory. What they're predicting is that by the next quarter, when we get our next GDP results, our next economic results, they expect our economy to not grow, but actually fall by 0.4%. And because of how significantly they expect our economy to start going negative, because of that, they expect that the United States economy will be in a recession by the end of 2023. This is from Morgan Stanley's U.S. chief economist, who sent out this letter to their clients today. Why did they send this out? Because of the slowdown that we saw in our GDP report today. So now, let's piece this all together. So the Federal Reserve Bank is going to have to make a decision on what to do with interest rates in the first week of May. They're going to be looking at the slowdown in the economy. And that slowdown in the economy gives the Federal Reserve Bank a little bit of caution on whether they should raise interest rates or not. Then they're going to look at inflation. And we're going to be getting more inflation data soon. But if inflation continues to be hotter than expected, or it continues to stay high in general, which it looks like it is, that's going to give the Fed more fuel to raise interest rates more aggressively. Higher interest rates also affect the economy, particularly the banking sector. We're seeing issues with banks like First Republic Bank, who is close to collapse because if they can't raise money quickly, they could be forced to shut down and get taken over by FDIC unless they can raise some money very quickly. They're going to be piecing this all together, and then they're probably also going to be looking at the layoffs and saying, well, we're seeing this growing trend with layoffs, but maybe they'll ignore that because the unemployment numbers are still low. But based off of all this information, now the Federal Reserve Bank is going to have to make a decision. Now, the question is, what are they going to follow as their rules? Because the Federal Reserve Bank 6 months ago said, we don't care about the economy. We don't care about anything except getting inflation lower. The Federal Reserve Bank 30 days ago said, yeah, we care about inflation, but we really don't want to see that much pain in the economy. Which Federal Reserve Bank are we going to see? Well, only time will tell, but what you have to understand is that high inflation is a difficult thing to fight. And high inflation also has a lot of consequences, because if we continue to see prolonged high inflation, that reduces the value of the dollar, that reduces your buying power, that reduces your earning ability, that reduces your savings ability, and that reduces the strength of our overall economy. Because if our dollar is weakening, and people are worried about the dollar in this era of countries moving away from the dollar, that could create issues about the strength of the dollar internationally. And that has a lot more consequences than an economic slowdown like a recession, because we know how to fight a recession. Recessions are a part of our economic system, but currency crisis, not so much. So this is where now the Federal Reserve Bank and their next meeting is so important, because well, every meeting is becoming more and more important because more and more things are happening. Now we're seeing more steadily decline in the economy. We're seeing inflation really get stubborn, and it's becoming tougher and tougher for the Fed to bring inflation down, and we're starting to see more and more pain in the economy. We've been seeing more bankruptcies recently. We've been seeing more layoffs recently. So now we're starting to see more and more things progress. And this is where now, again, 2023, is not the year for you to go out and finance a new truck. This is the year for you to get financially smart. Be prepared. That way you can come out of whatever is coming a financial winner, instead of just being the person that gets blindsided by what's happening, because this is something that we've been talking about for a long time now, and now we're seeing more and more of these things progress and come to fruition. And this is where now you want to be financially smart and understand what's happening. That way you don't panic, but that way you can capitalize on opportunities that might come your way.